you?
Okay. Thanks, David.
Thank you.
I believe that one of the goals of most business owners is to make as much money as they possibly can
Mhm.
and pay as little tax as they're legally required to do. And sometimes there are several different options that must be reviewed before we can take and recommend a specific course of action to how to best address that issue. But I think most people are capable, or most people can make the right decision for their unique situation if all of the options are explained and discussed and fully understood. And our job is to assist pointing out these various options and helping our clients make the decision as it relates to taxes. So this seminar, we're going to discuss, I think, some things that everybody is going to be having to deal with at some point or should be dealing. If you've got a business, you're going to have to address some of these items. The first one is how are you going to transact business? There's basically five different types of choices that we have: sole proprietorship, limited liability company, S Corp, C Corp, and partnership. I want to talk about a couple of these. Reed, you mentioned that you're a sole proprietorship. It's very simple to set up a sole proprietorship. You just set your shingle up and you start transacting business. You don't need to tell the Internal Revenue Service. You don't need to tell the state of Maryland or Virginia, D.C. that you're operating. You simply just do it. There could be some local issues that you have to deal with in getting an occupancy permit or a license to transact business locally. But from a federal standpoint, there is nothing that you need to do. You literally can keep records on the back of an envelope. Uh, you know, uh, it can be that informal. We don't recommend that. We recommend that you have use a formal set of books and records. Many times we have a client that will come into us and say, here's my bank statements. I didn't keep any records. Here's all my deposits or income, and can we reconstruct a you know tax return from these records? And then we go through and we find out that the taxpayer ended up getting a loan from a bank for $10,000. The taxpayer ended up transferring money from his IRA into the business account. Had money from a relative, short-term loan from a relative. Well, those are not income, and if we don't know that they're income, they're going to be treated as income when we prepare these documents, prepare the tax return. So it's very important to keep good records, no matter what type of business you have. But for a sole proprietorship, you really don't have to keep. There's no formal set of books required. Um, with a sole proprietorship, one of the things that's a drawback is the unlimited liability. Something happens while you're transacting business, you have unlimited liability. Your house, your bank account, all of your assets are subject to credit or risk. And that's certainly one of the drawbacks of a sole proprietorship. Sole proprietorship does not require any additional tax returns to be filed. All of the income, all of the expenses uh, become part of the personal return. There are additional forms that get filed, but there's no separate tax return that needs to be sent in. Um, if you have no employees, when you want to write a check, you simply write a check to yourself for your compensation from the sole proprietorship. Doesn't have to be the same amount each month. It could be whatever you like it to be. Obviously, depending upon how much income you have, but you simply write a check for yourself. There's no withholdings. There's no federal withholdings that you have to have. Social Security. Simply write a check. Limited liability company is the next choice of entity. Limited liability. If you're a single member, if let me back up. An LLC, limited liability company, requires that you contact your state where you're in and transacting business and actually establish a limited liability company. It's a very simple process. Normally, this is done through the State Corporation Commission for the state that you're in. Virginia, I think, has a $50 fee to set up the LLC. It's very easy to set up. You don't need, in my opinion, you do not need an attorney to set up the LLC. It's very simple to do, and you can do it yourself. If you're the only member of the limited liability company, you're what we call a disregarded entity for tax purposes. That means there are no forms, no tax returns, nothing that needs to be filed with the Internal Revenue Service. It's as if you were a sole proprietor. But the big difference between a limited liability and a sole proprietor is that you have limited creditor liability. Something happens to the limited liability company, your creditors can only look to the limited liability for satisfaction of its claims. It can't look to your house, it can't look to your personal assets. It can only look to the assets of the limited liability company. And most of the time, you're not going to have many assets in the limited liability company. You're making money, you're going to pay that money out. So the checking account balance should be, relatively small, in a limited liability company. If for some reason you do have another member um, in the limited liability company, you now have additional tax returns. You probably should talk to an attorney if you're going to have multiple members. Nobody needs an attorney to tell them how to transact their business, how to set up the business, how to make distributions. You can do that yourself. But when you have additional partners, how do you determine who's going to be, what's the price to get out? If there's uh, difficulty in coming to a decision, a mutual decision, and you can't come to terms. Your operating agreement will give you the guide to resolve those issues. So you should get an attorney for that if you're going to have multiple members. Many times, a taxpayer will put his or her spouse as a member in the limited liability company. If there's no compelling business reason to do that, I would recommend not to do that. Just so then you won't have additional tax returns that you have to file, and everything will be filed as a sole proprietorship. Next one is S corporation. S corporation is a corporation. You have to register with the state corporation commission, and it takes it's easy to set up, just like a limited liability company. An S corporation is a pass-through entity. When I say pass-through entity, the S corporation does not pay any tax. It passes through the income or expenses to the individual. And sometimes the tax results of an S corporation can be very similar to the tax results of a limited liability company or a sole proprietorship. A lot of people will sit and talk to their neighbor across the fence, and one neighbor will say, "Oh, I set up an S corporation." The other guy's or woman scratching her head and saying his or her head and saying, "Well, why did you do that?" And the person who set up the S corporation said, "Well, I went to a seminar and they told me to set it up." Sometimes the only people who make out in that situation are the accountant and the attorney. Sometimes there is a real need for, it makes a lot of sense to set up an S corporation, but don't go out and just set one up because you heard about it somebody told you that it's a good idea. Something to discuss with somebody before you do it. One of the drawbacks of an S corporation is that you have to pay yourself a reasonable salary. Compared to an S corporation or a limited liability corporation, where you simply write a check. Once you have an S corporation, you are now an employee of that company. You've got federal unemployment tax, state unemployment, Medicare, Social Security, federal income tax, state income tax. You have all those obligations that need to be paid. And with that is, administrative costs. You probably have to hire a payroll company to do that. You probably have to hire a firm to assist you with the preparation of the business returns. I'm not dismissing the S corporation as a choice of entity, but sometimes we can do without the S corporation and still end up in the same spot. Does anybody out there have S corporations now? I'll take that as a no. Okay. Anybody has set up the LLCs versus sole proprietorship? Okay. Um, next choice of entity is a C corporation. If you become a C corporation, one of the things if you form a corporation, all corporations are C corporations by default. You set up a corporation with the State Corporation Commission, you're automatically a C corporation. That S election that I mentioned before, you have to elect with the Internal Revenue Service to become an S corp. If you don't, you are then deemed to be a C corporation. A C corporation under our current law is probably not the most advantageous. A C corporation pays tax on the income that it earns, and then when money is distributed from the C corp, is taxed again to the shareholder. So in effect, you can have a double taxation. A corporation makes $100,000, the corporation is going to pay tax on that $100,000. And when the corporation pays what's ever left over to the shareholder in the form of a dividend or salary, that individual is then going to end up paying tax again on that same income. So, um, just be careful if you're going to get into a C corporation. It could be a costly form to do business if you don't do it correctly. Partnership. If you're considering a partnership, don't. There's a lot of pitfalls with partnerships, and I'd say that generally. Um, Certainly sometimes it's most beneficial to have a business in a partnership entity, but there can be some pitfalls that are I think, outside the scope of this presentation uh, that you should be concerned about or be aware of. One of the biggest items that music professionals have is their cost of the musical instruments, whether it's a piano, a cello, an organ, it's a violin, whatever it is. Congress is, in my opinion, is very generous with the way that we're able to deduct the cost of these instruments. In 2025, that might be a typo. I think I might have said 2024. 2024, the maximum that you can allow under Section 179, which is the Internal Revenue Code section, which allows for this depreciation, this very favorable depreciation, is $1,220,000. So, most people are not gonna use that and can use or not need to use that full amount. Section 179 allows for a full deduction in the current year of the cost of the equipment, as long as it's placed in service. If you buy a instrument, a piano, cello, violin on December 31st, and you place it in service, you're able to deduct the full cost of that in the year of purchase. Take it one step further, you buy this on time. You pay $100,000 for a piano, and you have an installment agreement that you're going to pay for it over time, 1 year, 2 year, 3 years. Um, you make one payment in December, you make no payments in December. You take title to it in December, you're able to deduct it in full. So you pay nothing for it, but you're able to deduct the full amount of the cost. Sometimes taking the 179 deduction might not be in your best interest. For example, you have you're just starting out in the business and your income is $10,000 and you have a $100,000 piano. If you take 179, the 179 deduction can offset that $10,000, but you've not been able to utilize that other $90,000. That 90,000, the unused portion of the 179 doesn't get lost, it gets carried forward to future years. You can't use that to create a net operating loss. So in that situation, if you had $10,000 worth of income and you had $100,000 worth of a piano and you wanted to write it all off, you could only use $10,000. You cannot use that to offset income from W-2 wages or Social Security, a pension, or interest, dividends, or anything like that. An option, an option for the 179 is you don't have to take the full 179 deduction. Uh, you can use bonus depreciation, which would be in lieu of the 179 deduction. Bonus used to be 100% deduction, very similar to the 179, just different limitations apply. Under current law, we have 60% of bonus depreciation. In that example that I just was talking about, you have $10,000 worth of income and you purchase a $100,000 piano. Using bonus depreciation would allow you to deduct $60,000 worth of depreciation expense against that $10,000 of income, generating a $50,000 loss, which could be used to offset other income, other wages, completely unrelated to your music business. So, just something to think about, something to consider. If neither one of those scenarios, either the bonus or the 179, are appropriate for your situation, you simply opt out of using either one of those methods and write it off. Piano is probably 5 years, a 7 year. I don't know exactly what life that would be. It's 5 or 7 years. You depreciate it over 5 or 7 compared to immediate depreciation. So those decisions are made when you file the tax return. And if you make a mistake and you say, gosh, I should have done 179 or I should have done something else, it's possible to go back in certain circumstances and amend a return. If you haven't done that in the past and you wanted to take the 179, it's possible to go back and take a look at possibly amending those returns. Okay, so retirement planning. As self-employed, everybody should be concerned with saving some money for themselves. Under the current provisions that we have, the solo 401k is something that I think should not be overlooked. And if you don't have a solo 401k, I would certainly recommend uh, uh, reviewing your situation to see if a solo 401k makes sense in your situation. Solo 401k has several parts to it. It has the equivalent of an employee 401k. If you're working for a business, the employee is allowed $23,000 to defer of their income and an additional $7,500 for individuals over 50 years old. So that's $30,500 that you can put into a solo 401k. So what does that mean? So if you make $30,000 in your Schedule C or in your business, you're able to put in $30,000 into a retirement account. You could defer all of your income that you made for the year. So there's two pieces to the 401k. The employee equivalent of the commercial 401k, the 30,500 that we just talked about. In addition to that, there's 20% of the net income from your business could be contributed to the solo 401k. Maximum that you can put in 2024 is $76,500. The solo 401k is not considered an IRA. It's considered a solo 401k, and you can roll over your existing IRAs into a solo 401k if you want to take advantage of a Roth conversion, but are unable to because you have IRA balances. I'm not going to get into the specifics of Roth conversions, but one of the limitations of a Roth conversion is if you have an IRA balance, the Roth conversion sometimes can be expensive. But if you have no IRA balance, the Roth rolling your IRA into a solo is advantageous. There's little or no administrative costs with setting up a solo 401k plan. Another type of plan that is very, very we see an awful lot is a SEP plan, Simplified Employee Pension Plan. SEP plan is limited to 20% of the net income from your business. So if you take somebody that has $30,000 of income, compare that with a solo 401k or a SEP, somebody making $30,000 could put the full $30,000 into a solo 401k and have no taxes on that income that they made. If you have a SEP, you could only put in 20% of the 30 or $6,000. That would be the max that you could put in. So, is the Roth set up at a bank? You can set it up at a bank. You can set it up at a financial institution. You can set it up wherever you'd like. There's no restrictions on setting that up. So just take a look at the different those two different plans, SEP or solo 401k. Under current law, the traditional IRA is still something to be used, in my opinion. You don't get a deduction for it if you have another type of retirement plan. So these plans we talked about, a solo 401k or a SEP plan, would preclude you from setting up or could preclude you from setting up a deductible IRA. You still might want to make a non-deductible IRA because you'd like to have that money grow tax-free in a retirement account. Just something to consider. We recommend setting up a traditional IRA, non-deductible if you can. If you can't, you can't. The best place to put money, if possible, is into a Roth IRA account. What's wonderful about a Roth is the income grows tax-free for the rest of your life as long as it stays within the IRA. You buy the next Google, the next Apple, pick a stock, and in 30 years it goes from $1,000 to X number of dollars. When you take that out, you don't pay any tax on it. The appreciation, the dividends, anything that's been paid on that stock is completely 100% tax-free, at least under current law that we've got with Congress right now. This blurb that I put in here about making a Roth contribution on behalf of a child, is something that I think should not be overlooked. If you have a 15-year-old kid that's working in a grocery store making a couple $1,000 a year, I would certainly consider making a Roth contribution for that person, and continue to do that as long as you can. Because after a while, they might not be able to make a contribution because of income limitations. But at that level, the income grows tax-free and compounds for the next many, many years. It's a wonderful long-term planning. Local filing requirements. I mentioned before, limited liability company. You don't have to tell anybody you're doing business. You don't have to file any special tax returns. It's all becomes part of your federal return. in Northern Virginia, and I think in Southern Virginia also, most of these counties have this. You were required to pay and file for a BPOL, Business and Occupancy License Tax. It's a tax, local tax that's based upon the gross receipts of your business. Uh, and if you don't have, you file with the local jurisdictions and tell them, what type of business you have, and they send back a rate for your business. In Fairfax, we have either 11 or 15 different rates. We're taxed at 31 cents per rate, 31 cents per $100 of gross receipts. Other businesses are taxed based upon cash expenditures, not so much gross receipts, but expenditures, how much they paid. Builders are taxed this way. So just be careful. Fairfax is very aggressive in matching up federal tax returns. When you file your federal tax return, you say your name and address, where you're transacting business. Federal gives that information to the state. The state gives that information to your local jurisdiction. And they match the returns up and say, okay, Carl, you filed a tax return in Fairfax County, but you didn't file your business and occupancy license. Why is that? You'll get a dunning notice and say, please file it. In addition to the business and occupancy license, you're also required to file personal property tax on business assets that you own. So BPOL and a personal property tax. Maryland and DC do not have the BPOL, but they do have the personal property tax. Next up is method of accounting. There's a couple. Matt, if you could get the next slide there, method of accounting. All right, the method of accounting. Most people will. Thanks. A couple different methods we could use. Cash, which is what most people should be using. Cash is cash. Cash, you pay tax on money coming in, you get the deduction when you pay it out. Versus the accrual method, when you pay tax on income when you earn it, not when it's received, when it's earned. And you also get a deduction for expenses when incurred, not yet paid. Cash is much simpler to use. For service businesses, we would always recommend a cash basis. Most people would not want to pay tax on income that they haven't received. And but it is an option to choose which method that you want by the filing of your first tax return. Okay, so let's talk about some of the specifics of the deductions that are available for self-employed musicians. An often deduction that's overlooked. Often this deduction is overlooked. Medical insurance premiums. A self-employed individual is allowed to deduct all medical insurance paid for himself or herself and spouse and family members, dependents. Long-term care insurance premiums are also allowed to be deducted. If you are working for somebody, one spouse is working and has a medical insurance plan at their employer, that cost is not something that you can deduct on your personal return. Medicare insurance premiums, both taxpayer and spouse, can be deducted for a self-employed individual. Most people will have a designated area in their home for an office and home. They have their lessons there. They have a desk there. They do their correspondence. They do their billing. They keep their record keeping. If you have such a space, you're allowed to take a deduction for an office and home. That there's a couple different ways to deduct this based upon the square footage of your home. based upon the square footage of your office and home space compared to the total square footage of your home. So if you have a 10 by 10, 100 square foot, and you got a 2,000 square foot home, well, 100 over 2,000 is what you'd have as that ratio would be a deduction that you would a fraction rather that you would multiply all of your home operating expenses, your insurance, your repairs, your interest, your real estate taxes, your home warranty fees, any of those expenses are needed to maintain your home, your office and home, and you allocate them based upon your office. You allocate them based upon the square footage of your home. Got a question here. Does office and home deduction also apply to rental property? We can discuss that later on. That's a little more complicated. Um, the keeping the records for a home office. Sometimes, you say, well, I don't want to keep all those records. I don't want to keep my insurance. I don't want to keep my, homeowners fees, my repairs, maintenance. I don't want to keep a records of all those. IRS has simplified rule. It says $5 per square foot for the office and home, and that's just you just have to tell them how many square feet you have, and you can deduct that on Form 8829. Very simple process. A health savings account is an account that's allowed for self-employed. Money that goes into this health savings account is treated as a deduction, and those monies can only be utilized for qualified medical expenses. In order to have a health savings account, you must have a high deductible insurance plan. If you don't have a high deductible plan, you can't use that. You can't use that health savings account. If you go to a show, if you go to a concert or recital, I shouldn't have said a show because people say, well, I'm going to go see the Springsteen concert and I want to take that as a deduction on my return. That's not what I'm talking about. I'm talking about you go to a recital, a concert that's related to your work. Those fees, those tickets can be treated as a deduction for your work. You attend a convention, you belong to an association, they have a convention, you're going to go to that, you're going to travel, and you're going to incur hotel costs. Those are all qualified 100% deductions. Many people travel from their home to a student's place of business. Make sure that you're taking the mileage that you're allowed. In 2024, we're allowed 67 cents per mile for as a mileage rate. Meals expense has been going back and forth last several years. Due to the pandemic, they liberalized the deductions, and we're allowing 100% deduction for meals. Now it's only 50%, but still, 50% is better than nothing. Everybody who is self-employed should be claiming a cell phone and internet expense on their return. In this day and age, a computer, cell phone, and internet expense is without, I mean, that's just accepted, those are accepted business expenses. You might not be able to get 100%, but you should be able to get a significant portion of those expenses. This next bullet point, ordinary necessary business deductions. I have Bill Gates. Here's an example. The law says in your business, if it's ordinary and necessary to transact business, the IRS will allow that deduction. What is ordinary and necessary for one person might not be ordinary and necessary for another person. I'm going to have, if I have Bill Gates rides to and from work in an armored car. If I drove to work in an armored car, that's not a deduction for me. It'll be probably a deduction for him because of his status in life. So, but it's the same expense for the two of us will yield different tax deductions. So just uh, that is ordinary necessary is the test whether something should be deducted or not. Education expenses. If you're taking a class, a music class, a business class, something again that's going to be ordinary necessary in your business. Does it help with your business? Does it enhance your business? Then you should be able to take that as a deduction. Uh, the more documentation that you have for these business expenses, the better off you're going to be upon audit. Um, One of the ways that we suggest keeping track of all these expenses is to use QuickBooks. That's becoming the standard. It's becoming the norm. Um, Very easy to use, very simple to use, and something that I would highly recommend. Most CPAs work with QuickBooks. You can give the file away with all your data to your CPA, and they will be able to take that data and assist with the preparation of the return. A question that we get a lot is for sole proprietors is estimated tax payments. How do we make these estimated tax payments? When do I need to make them? How do I make them? The IRS gives us two safe harbors for making estimated tax payments. One is paying either 100 or 110%, and that's based upon the level of income that you have. So it's either 100 or 110% of the prior year's liability. Your tax liability in 2023 was $10,000. Well, you better have paid in 2024 estimated payments of at least $10,000, or you're going to get hit with some penalties. That's safe harbor number one. Safe harbor number two is 90% of the current year rather, liability. So if your income's always going to go up, we always want to pay in the prior year's liability because we know what that number is. If your income's going to be going down, well, you wouldn't want to pay tax on the prior year liability. Why pay tax on the $10,000 if you know that you're not going to be having $10,000 worth of income because you didn't work in 2024? So the IRS gives us another safe harbor paying the lower amount or 90% of the current year. So that covers my I know I went over a little bit. My apologies for that. Try to go through it as quick as I could, but I thought some of those were important. And David, I hope I didn't run over too much of your time here. I'm just looking. I realized I went a lot over. Sorry about that.
Imagine that, a CPA going long.
Yeah, I got lost. I got into it, David. It overtook me.
Okay, before we move on, does anybody have a specific question that they'd like to ask Carl? Because we're moving on to Matt Bachman next. But any of the teachers in the group have a question they'd like to ask? We will make this material available to everyone via email, and also Carl's contact information if you would like to speak to him. He's a great guy, and I think you can tell from his presentation that he knows his stuff. So Carl, thank you very much.
And
And
my pleasure. And again, I apologize for going over. I had no sense of time there and I just realized I had gone way over. My apologies to everybody.
no worries at all.